All right, so thanks for joining me in today's video. I want to share with you some insight on where you might go ahead and sell your put option and understanding on how far a stock can go when it's starting to pull back. So I'll give you some take and insight here. So we're going to go in and give you some option trading idea and concept. Now, if you get confused by this, you could definitely check out the one-on-one coaching things that I have available. You can just book a Zoom meeting where we can chat and interact live by video. And you can also work with me for 6 months plus. And if you want to just check out some of the classes that are available as well, you can do so on our website at tradersfly.com. All right, so let's kind of get started on this concept. I want to show you something regarding the standard deviation. So if you've never heard this, this is kind of the statistical things when it comes to how far a price might move, for our case at least. Now, standard deviation can be used in a lot of different things. For our case and purposes, we'll be looking at how far a certain stock price can move. Here's a zoomed in version of this. So what it's basically saying is that 68% of the time, like let's say the current price right now is at $100, 68% of the time we're going to be in this one standard deviation range, and price will be either up or down at that level. Then you have a larger 2 standard deviations or 2 sigma move, okay, where this is 95.4%. Okay, so that move will then be in 2 standard deviations 95% of the time. Okay, and 3 standard deviations is 99.7. So if we go ahead and look at the standard deviation of the move, and let's say we take, for example, Tesla here, we could go to the 28-day option and say, hey, I wonder how far this stock could move in the next 28 days. Well, what you can do is go to the expected move here. This is 132, though this is the implied volatility. This is the expected move. So call it 130. So we're expecting a 130-point move up or down in the stock. So the current stock price is 737.12 as we speak. But now what we can do is say, okay, well, let's add 132 points here, or subtract 132. And that's going to be the answer for how far this stock can move. So you could take a calculator or you could do it mentally by hand. But here we go. So we could say current stock price is 737, and we can subtract 132 and we get 605. Okay. Or the other way is 737, and we add 132, and we get about 869, so 870. Now, the thing to consider when you're looking at this expected move, that is for 1 standard deviation. Now, what if it goes 2 standard deviations? So what we can do is now take 132 times 2, that's 264. So really, when you're starting to look at things, that's 737 plus or minus, what do we say, 234 or so? 264. So we said 264 on that move. So this stock can move 264 plus or minus. So when I'm looking at 737 and it goes down, let's say 264, that stock could actually go down to about 473. Now that's not as likely, but it's possible. Or the other fact is it could go 737 plus 264, and we could be up in the $1,000 range. So my point being is, if you're looking for a standard deviation in general for like, hey, 68.4% of the time, which is here, 68.2% of the time, it's going to stay in this range. Okay. Then what you'll do is you'll go ahead and say, okay, well, let me look at 1 standard deviation. If you want a little more range beyond that, then you could go a little further beyond that. So here, 132. So I could say, why don't I sell it about 150 points away? So now I could take this calculation of 737 minus 150. And if I want to sell my put, I should sell it around 587, maybe 590, right around that zone. So now I'm looking at, okay, well, 590 is around this spot. And then if I go in and do more, okay, the delta, there's 590. It's about a 13 delta in this case. So that's kind of why or how you might use this approach based on standard deviations. Now, you could just do a probability basis. Okay, I want a 13 delta, 15 delta, 17 delta. You could do something like that too. That's not a problem. But if you're looking at it from a standard deviation basis, you could look at it like this. And now you could sell the 590 and you've got yourself some put contracts right here at around 590 that you could sell. And, you know, you could bump it up a couple contracts if you like. And now you've got yourself a spread that's at least or about that one standard deviation move outside in that range. So that's kind of how you might construct it and think about it if you're looking at standard deviations. Anyways, I hope that helps. Truly appreciate it. Thank you so much for joining me. If you learned something new, great. You're continuing to evolve. If you're struggling, feel free to reach out, grab a coaching session or one-on-one. Decide to work with me and we can work together week after week, month after month, and make sure you get this stuff and understand it. All right. Thanks again, and I'll see you in the next video.